Okay guys, I want to take a second here to discuss the allowance method with respect to bad debt expense and uncollectible accounts. Alright, so the direct write-off method is first discussed in this chapter, and a problem that a company might face with the direct write-off method is that the company might record the sales in, let's say, one accounting period, and 2 or 3 years might go by. We might continuously try to collect and collect and collect, and maybe they keep leading us on and leading us on about the fact that they are going to pay us, but ultimately they do not pay us. And so we might have a sale being recorded in one accounting period and the bad debt expense being recorded several accounting periods later, and this violates the matching principle. The direct write-off method, like I said, that's a pretty major shortcoming of it, and as a result of that, generally accepted accounting principles does not allow companies to use the direct write-off method if the amount of receivables is significant, aka material. So the allowance method is what has to be used if there are significant amounts of accounts receivables. So with the allowance method, an entry is made at the end of an accounting period, same accounting period that the sales were recorded in, to estimate the amount that is going to be uncollectible. Okay, and so what we do is we debit bad debt expense and we credit this allowance for doubtful accounts. Now this allowance for doubtful accounts is going to be that in combination with the amounts of accounts receivables is known as our net realizable value. And that's basically the amount that we think we're going to be able to collect. Alright, so this is made, we can see here, at the end of an accounting period in preparation for the next accounting period. This allowance for doubtful accounts is a contra asset account. Okay, here you can see I mentioned a net realizable value. Now in a later accounting period, we jumped from 2011 to now we're in 2012 here with this part of the problem. We discover somebody who's not going to pay us. At the time when we record this entry here, we record the bad debt expense, but we don't know who it is that's going to stiff us. We don't know whose accounts receivable to get rid of. We don't have a crystal ball. We don't know until they actually go bankrupt, quit returning our calls, quit returning emails, whatever the case may be. So anyways, this is the entry that's recorded once we learn who specifically it is whose receivable we need to remove from our books. In this case, it was John Parker. And remember, these receivables are always tied to a specific company or person, right? If we don't have a name associated with an accounts receivable, it's going to be extremely difficult for us to ever be able to collect anything like that. Now it's kind of tricky to come up with this method here, with the dollar amount that we use with the allowance method. And there's two different approaches that we can take. These are the two different approaches. The percentage of sales method. I explained this one in the other video that I've made for this chapter. And then there's the analysis of receivables method. I'm going to focus on that now. But these are the two choices that are commonly, or the two methods that are commonly used to come up with that amount for that adjusting entry that's made to fill up that allowance. We fill it up with a credit. So let's talk about accounts receivables and the fact that the older an accounts receivable becomes, the less likely that it is going to be collectible. If you lent a friend $800 last week, you're probably feeling pretty strongly about the fact that you're going to be able to still collect that. If you lent a friend $800 4 or 5 years ago, they're probably still not your friend if you're still trying to collect the money from them, and you probably at that point are pretty confident you're not going to collect it, right? So the older a receivable becomes, the less likely it is going to be collected. Now there's an illustration here. It's kind of a little bit confusing, but I'll try to explain it to you. Sometimes the publisher will put this little tear here in a page, and that just represents there's a lot more information. They just didn't have room to show it all. We can see here it jumps from 6 down to 21, right? So there's all the way, there's 7, 8, 9, 10, 11, 12, 13, all the way to 21 that's missing there, right? But that's okay. We don't need that to understand this exhibit. What we need to understand is that there are a bunch of different accounts receivables that all total together $240,000. We're going to take this $240,000 and we're going to categorize it based on how old the amounts are. Okay? So for example, $125,000 of this $240,000 is not past due. We work our way on over here. Let's just stop here for example. $8,900 is between 61 to 90 days past due, and we have $14,000 that's over a year past due. Now notice these percentages down here. This says the percent uncollectible. The further away from not being past due we get, the greater this number gets. So we're estimating that 80% of this $14,000 is going to be uncollectible. 80% of those amounts over 365 days. Let's work our way to the left a little bit and let's take a look at this one. So we're saying if an account is between 91 to 180 days past due, we're saying that we estimate 30% is uncollectible. And where are we getting these percentages from? Well, probably from the company's history, from its own track record, right? From its own experience. If it's the first year, maybe we could take a look at some statistical information to come up with those figures. Example here of some information from a study, right? So if this was the first time you as a company were trying to estimate this, maybe you would use some data like this, or maybe something specific to your industry. But like I said, I think that the company's own track record is probably the best information that could be used to come up with those estimates. So we're going to take each of these dollar amounts that we've categorized, we're going to multiply them by their respective percentages that we believe are going to be uncollectible, and we're going to come up with a dollar amount. So of all these receivables here, once we've categorized them, this is the dollar amount per each category that we estimate is going to be uncollectible. So we have a total of $240,000 of receivables, and we're analyzing these, and we're coming to the conclusion that we think $26,490 of those are not going to be collectible. Okay? So the net realizable value in this case would be the difference between the $240,000 that we have on our books and the $26,490 that we think is going to be uncollectible. This is called a balance sheet approach because we're focusing on two things: the amounts of accounts receivable, that's a balance sheet account, and the allowance for doubtful accounts, which is also going to find it's also going to be located on the balance sheet. But the fun doesn't stop here. We know that we want the allowance for doubtful accounts to equal this $26,490, but we're going to have to look at what the balance is in the account already. In the example here that we've worked through a second ago, we're going to pretend that at the end of the accounting period we have $3,250 in this allowance for doubtful accounts, and I drew us a little T account here, right? So we're going to pretend that we happen to have, by the time we've written off all the other accounts throughout the accounting period, we get to the end, we're left with a balance of $3,250. Well, we want our balance to equal $26,490 based on that analysis that we just did, right? $26,490. Excuse me. So in order to get from $3,250 to $26,490, it's going to require a $23,240 credit to the allowance for doubtful accounts. Okay? And the offsetting debit's going to go to bad debt expense. So we're not going to record an expense or any type of bad debt expense until the end of the accounting period, when we are preparing these this adjusting entry to fill up this allowance. Maybe this illustration will help you here. Okay, we fill up at the end of the accounting period an adjusting entry, the allowance for doubtful accounts, with a credit, and then throughout the accounting period we're going to debit it when we find out that folks are not going to pay us and the amounts are uncollectible.